You've heard me say it before. Accumulating wealth of any kind is about keeping money. This means that taxation is the greatest obstacle to you and me achieving our financial ambitions. And it also means that we should make every effort to legitimately reduce the taxation we pay if wealth accumulation is our goal. So, for those of you who own limited companies, for those of you who aspire to perhaps owning limited companies in the future, how do you go about taking money from those companies without paying tax? There are many legitimate ways that company owners can extract funds from their business without paying tax. And those of you who've viewed our videos or read our newsletter know that one of my favourites to talk about is the Executive Retirement Fund. And why is that my favourite? It is my favourite because it's the sharpest tool in your box. It is the vehicle that allows you right now to take a substantial amount of money from your company, put it in your own name, and pay little or no tax upon it. So let me first of all outline the benefits of an executive retirement scheme, a retirement scheme that's contributed to by your company. Benefit number one. You can move money from the ownership of the company to your legal ownership and pay not a single penny in taxation upon it. Benefit number two, that movement is treated as an expense within the company's accounts and therefore can be written off against corporation tax. Effectively, that means that 12.5% of the money moved is paid for by the state. Benefit number three, commercial risk has been reduced. Money moved in this manner from the company balance sheet to your retirement fund is now protected from the creditors of the company. So based on those three benefits alone, you might want to use this type of vehicle, but they're not the only benefits. Benefit number four, within the vehicle, the investments made are completely exempt from both income and capital taxes. So for a moment, let's compare taking a nice round number, because the maths are easy, €100,000 out of your company. If you take that as salary, you get to keep roughly €50,000. You invest €50,000 in an attempt to accumulate wealth, and any gains you make are taxed potentially at another 50%. So the €100,000 coming out of the company turns into €50,000 in personal investment, and the return on that is roughly halved on the tax you pay again. Compare that to the retirement fund. The €100,000 goes straight into your retirement fund, no tax deduction. So in that example, you have twice as much money invested. And within that vehicle, the growth is completely exempt from income and capital taxes. So when compared to taking money out as salary, taking it out as a retirement contribution doubles the amount of money you get out and doubles the return as well. And we're not finished there. Benefit number five. When you come to the end of a retirement fund, you can get 25% of the money accumulated as a lump sum, and the first 200,000 of that lump sum is tax exempt. Up to 300,000 is taxed at just 20%. So if you're at the maximum at retirement, you can take a lump sum of $500,000 and pay only €60,000 tax on that lump sum. That's an effective tax rate of 12.5%. When I tell these facts to individuals, sometimes they say, yeah, but I can't get the money back until I'm 65. That isn't true. Executive pensions in Ireland are accessible between the ages of 50 at the earliest and 75 at the latest. So it must be said that if you're accessing that scheme between 50 and 60, that's considered what the revenue referred to as early retirement. And early retirement requires the approval of your employer. But in this case, you are the employer. So at your discretion, you can access the money from 50 onwards. One word of caution though, once you access the money, you can no longer put any more in. So the timing of access is vital too from a tax planning point of view. Knowing all of these benefits, the next question on your mind may well be, well, how much benefit can I take of this? And if we were having this conversation 10 or 15 years ago, the answer would have been virtually unlimited. There was little or no caps on retirement funds in Ireland back then, but there are caps now. But the beauty is that while there's a cap at retirement, which I'll deal with in a minute, since January 2023, there is no cap whatsoever on the amount of money your company can put into this scheme. No cap for you, no cap for your spouse if he or she works in the company too. So you've got an ability to withdraw sizable amounts of money from a limited company, drop it into your own retirement plan, and pay not a single penny in taxation. No caps apply. While this is true today, we understand that this no cap applying to annual contributions or to contributions from a company, we understand that will be reviewed and may well be changed in the next budget, which will be read by the Minister to the Dáil on October 1st next. Whether the change happens on October 1st or whether it happens, as most changes within the budget do, when the Finance Act is published, which is generally the following January, I can't tell you because we don't know yet. What I am saying is that if you have sizable cash assets sitting on the balance sheet of your company, if they have remained there because you haven't figured out a way of getting them out tax efficiently, then here's your opportunity. Again, when I tell people about these benefits, they often ask me, but what about the costs? What about the insurance companies? How do I know that the tax I'm saving won't be chewed up by charges and other costs down the line? And to answer that question, there are two types of pension fund out there available to you. The first is the one you're likely thinking about right now, the Irish Life New Ireland Zurich Pension Fund. And let me tell you some home truths about those schemes. The first thing to tell you is that when you put money into Zurich or Irish Life or New Ireland, or anybody else for that matter, you transfer legal ownership of the money to the insurance company. The money doesn't belong to you, it belongs to the insurance company. Not only that, when you do that transfer, there are no independent accounting processes applied to the retirement scheme funds that you invest in. So for all we know, Irish Life, Zurich, New Ireland or whoever are getting 20% a year return on the money you've given them, and they're giving you 5% a year because it's their money legally. They don't have to tell you. Another thing is it's all but impossible to tell the charges in those schemes. Some of those charges are openly disclosed and some are hidden from view. And finally, from an investment perspective, you typically are given a bunch of own brand investment funds described as low risk, medium risk, high risk, and they're the options you get. Now let's compare that to what is called a private retirement fund. There are about 40 companies in Ireland licensed by the revenue to provide and maintain this type of fund. And here's the comparison difference. The money within a private retirement fund is held in custody, in trust for the beneficiary. It never transfers ownership. Private retirement funds, as part of revenue approval, have to produce an independent set of accounts every year. So you know exactly what the charges are. You know exactly you're getting the returns you should be getting. The charges on private retirement funds are open and declared in advance, and typically speaking paid by the limited company, your employing company, not by your fund, which making them fully tax deductible and allowing VAT to be written off in the normal fashion. And finally, from an investment point of view, private retirement funds can frankly invest in anything you want to invest in. It's easier to tell you what private retirement funds can't invest in than to tell you what they can. Here's what they can't invest in. They can't invest in any asset you already own. So they can't buy an asset from you, from your mom, from your dad, from your baby brother, from your wife or husband. They can buy an asset from me, but in that case, the revenue call that self-dealing. So self-dealing is prohibited. Neither can they buy an asset from a company in which you have a controlling interest. The other prohibition, so you've got self-dealing is the first prohibition. The other prohibition is called pride and possession items. So fine wines, classic motor cars, racehorses, all arguably investments, none of which are allowed within a private retirement fund. Many years ago, I used to do the business briefings with ISME, the Small Medium Enterprise Association in Ireland. And it's an event which happens generally in January every year, and they take a bunch of invited speakers around to the regions and they talk to their members. I shared the platform in one of these events with a gentleman by the name of Clive Slattery, and Clive was the head of the Retirement Benefits District of Revenue at the time. And he used to talk about these pride and possession items. And he told the audience every day that I heard him give the talk. The revenue lie at wake at night, worrying about you driving around in half your pension fund, classic motor cars, drinking the other half, fine wines. So it's prohibitions, self-investment, and pride and possession items. Beyond those prohibitions, any investment you care to mention. Land, property, gold bullion, cryptocurrencies, stocks, shares, bonds, etc., etc. Everything available and everything completely exempt from income and capital taxes. You may have heard me say this before, but the intent of Ask About Wealth is to give you new knowledge and new information so you can better choose your financial advisory team in the future. You can better question that team in the future, and you can better instruct that team so that they're doing what you want them to do, not following their own agendas. So, what's the call to action here? If you're a company owner of a profitable business, especially if you've been retaining profits simply to avoid paying tax, it is time for you to look at one of these schemes and to see how it would fit into your overall financial plans. Down the line, I mentioned briefly about the lump sum that you can take from these schemes. And it is true that under Irish legislation, any further income beyond the lump sum will be taxed in the normal fashion, but it will also have the normal tax credits against it. But that is an Irish rule. Who's to say that your retirement scheme will be subjected to Irish rules down the line? One of the key pillars of the European Union is the free movement of people and the free movement of capital. And what that means for you down the line is you're able potentially to move your retirement scheme to another EU jurisdiction and be subject to their rules, not the Irish ones. And there are a number of EU jurisdictions where the rules are considerably better. Too complex to go into much detail here, but it is our intention to invite onto our podcast in the future a gentleman whose company is doing this right now, whose company is moving retirement schemes into different EU jurisdictions, and by doing so, avoiding Irish minimising legislation, which caps the retirement schemes at a certain level, which forces you to take income at a certain level beyond your lump sum repayments, and indeed, which pays far higher tax-free lump sums than would be available in the Irish jurisdiction. Watch this space. Only remains for me to say thank you for listening today. Please share this with anybody you feel could benefit from hearing this new knowledge and new information so that they can better instruct, question, and choose their financial advisory team down the line.